Welcome back. Today we are going to do a deep dive into a company that most Wall Street analysts are scared to touch. And frankly, that is exactly why we are here. We are looking at Kaspi.kz. Now, if you screen for stocks based on the scary headlines, this one pops up immediately. It's a bank, it's in Kazakhstan, it's next door to Russia. On the surface, it looks like a value trap. But if you dig into the cash flows, if you look at the return on equity, and if you look at the how management allocates the capital, this isn't a trap. It's a fortress. I know a fortress in a frontier market. You're crazy, right? Maybe. But for the next 20 minutes, I wanted to suspend your geopolitical bias and just look at the business fundamentals with me. Because what I see is a monopoly trading at a fraction of its intrinsic value. So let's get into it. I always start my analysis with the business owner's question. If the stock market closed tomorrow, no tickets, no liquidity, you can't sell for 10 years, would you be happy owning this business? With Caspi, my answer is emphatic yes. Why? Because I'm not buying a stock certificate here. I'm buying a toll bridge. This company has effectively digitized the economy of a nation. 14 million active users in a country of 20 million. As a value investor, I look for inevitability. Is it inevitable that people will use this product? Yes, if you live in Kazakhstan, you don't really have a choice. You pay your taxes, your bills, buy your groceries here. We are buying a royalty on the GDP of an entire region. That is an asset I want to hold forever, regardless of what the share price does next Tuesday. This chart right here, this is why we value invest. The red line is the business reality, revenue growing at 20% CAGR, net margins at nearly 40%. The intrinsic value is compounding steadily at the top right. The gray line is the share price, it's flat. Mr. Market is currently manic depressive about this region. He is pricing this company at a PE of roughly 6.8. Think about it. A company growing at 20% trading, 20% trading at less than 7 times earnings. This gap, it's a massive jaw-dropping gap between the price and the value. That is our margin of safety. We are buying dollar bills for roughly 50 cents because the market is too afraid to pick them up. So what is the thesis? It comes down to three things. First, the moat, and I mean a real economic moat, not just a brand name. They have a sovereign pricing power. They are plumbing of the economy. Second, the catalyst. For a long time, the knock on the Caspi was limited TAM. They just solved that by buying Hapsiburada in Turkey. They've gone from market of 20 million to over 100 million people. Third, the valuation. We're getting a fear discount. The market is pricing in a disaster scenario that the financial statement just don't support. We're getting the growth for free. Let's look at the machine itself. How does this thing actually make money? It's an ecosystem with three layers. Payments at the bottom. This is the utility. Marketplace in the middle. Fintech at the top. Now, usually I hate the word ecosystem. It's a buzzword corporate types use to sound smart. But here it's actually accurate. The payment layer is the hook. It brings people in, the marketplace keeps them there, and the fintech layer, that's where they harvest the cash. It's a self funding machine. They don't need external capital to grow because the business generates so much free cash flow internally. The slide explains why their margins are so fat. It's about efficiency, acquisition. They acquire customers for free through peer to peer payments, zero CAC. Engagements, users transact daily. Monetization, they cross sell high margin loans. Most banks spend a fortune on marketing to get you to open a credit card. Caspi spends nothing. You're already there trying to buy a TV, they just offer you the money to buy it. It's ruthless efficiency. As an investor, I love business that don't have to spend money to make money. Let's look at the P&L, or specifically the truth teller. Look at the box. Net income margin of 38%. 38%. In the banking world, that is unheard of. They aren't competing on price, they are the monopoly. When you see margins this high and stable, it's the clearest sign of durable competitive advantage. This isn't a fluke, it's structural. Let's talk about the moat. I call it the trap. It's not just everyone uses it, it's that government uses it. You pay your taxes on Kaspi, you register your car on Kaspi. The switching costs here is insane. If I want to leave my bank in the US, it's hassle. But I can do it. If Kazakh citizen deletes Kaspi, they basically unplug themselves from society. There's a kind of customer loyalty, if you want to call it that, that guarantees cash flow for decades. Briefly on the macro, I don't like to base an investment on macro predictions because economists are usually wrong. But the tailwinds here are undeniable. Kazakhstan is a resource rich. Oil prices stabilizing around $80 is good for consumers' wallet. But more importantly, look at the map, the middle corridor. Trade is flowing from China to Europe through Kazakhstan. Kaspi is the digital toll booth on the physical trade route. We aren't betting on oil prices, we are betting on the increased velocity of money in this region. Let's do a relative valuation check. This is where it gets silly. Kaspi trades at 6.8x earnings. Mercado Libre trades at 52x. Stoneco trades at nearly 10x. Now, I like Mercado Libre, but is it worth 7 times more per dollar of earnings than Kaspi? Kaspi has a higher ROE. They are more efficient with their capital. The market is purely discounting the geography. As a value investor, my job is to exploit that prejudice. I am happy to buy the better business at the cheaper rate just because it has a weird zip code. Now, the growth story, the Turkish gambit. The bear case was always Kazakhstan is too small. Well, they just bought Hepsi Burada. They entered Turkey. Turkey is a G20 economy with 85 million people. This acquisition changes the math completely. We aren't just dividend play anymore, we are growth play again. The TAM just exploded. Here's the strategy. Hapsiburada is a low margin retailer. They move a lot of volume but don't make much money. Kaspi is going to graft their fintech engine onto that volume. They are going to offer BNPL, buy now, pay later, and consumer loans to those 85 million Turkish customers. It's the exact same playbook that worked in Kazakhstan. They are taking a low return asset and injecting high return DNA into it. If they achieve even the half of the success in Turkey that had at home, the stock is a multi-bagger. Now, this is my favorite slide, management. In value investing, the jockey matters as much as the horse. The founders, Lomtse and Kim, own over 40% of the stock. Their net worth is this company. They aren't hired guns looking for a bonus, they are owners. And look at their capital allocation. When the stock dropped last year, they didn't make excuses. They authorized a $100 million buyback. They saw their stock trading at 6 times earnings and said, "That's too cheap. We are buying it." That is exactly what I see. rational, opportunistic capital allocation. Let's talk numbers. What is it worth? Bear case, let's say I'm wrong. Turkey fails. Kazakhstan stagnates. The value is still around $85. We are trading at $76. So in bad scenario, I am buying a dollar for 90 cents. Base case, a moderate success, we are looking at roughly 135 to $145. That's an 80% upside. And the bull case, don't even talk about it. We are looking at 200 plus dollars. This is what Monish Pabrai would call heads I win, tails I don't lose much. The downside is protected by the cash flow, the upside is uncapped by the growth. And here's a sanity check. Some of the parts, if you break this company up, the fintech division is worth $10 billion. Dollars. The payments division is worth $7.5 billion. Dollars. A total $17.5 billion. Dollars. The current market cap is just $15 billion. Dollars. So you are buying the fintech and payment businesses at a discount, and you're getting a marketplace, an entire Turkish expansion for free, literally free. As a value investor, when I see free options attached to a high quality business, that could make anybody interested. Now we have to be intellectually honest. What kills us here? Let's look at the pre-mortem: geopolitics, secondary sanctions. It's a risk, but they are big four audited and transparent. Currency, the tenge could devalue. Execution, Turkey could be harder than they think. These are real risks, but remember, risk is the price you pay for returns. If this company was in Switzerland, it would trade at 25 times multiples, but we are being paid handsomely to take this risk. So the verdict, as per me, as per my thesis, it's a strong buy. We are accumulating shares here. We have a fortress balance sheet, owners, operators, a massive moat, and a price that makes no sense. I'm willing to look foolish in the short term to be right in the long term. That's the value investor's creed. I'm buying the toll bridge. Thanks for watching. Do your due diligence, and I'll see you in the next one.